Before we start this week's podcast, I'd just like to say a quick thank you to our sponsor, Money Farm. Now, for those of you who don't know, Money Farm are one of the biggest digital wealth managers in the UK and Europe. They not only have a stocks and shares ISA, but they now have a pension which they can run for you. And now we've secured an exclusive deal for Money to the Masses podcast listeners and Money to the Masses readers, where Money Farm will reimburse the exit fees and dealing charges charged by your existing pension provider if you transfer to them. You can find out our view on Money Farm by going onto the moneytothemasses.com website and searching for Money Farm Pension Review, where you'll also find all the T's and C's. Now on with this week's show.
Hello and welcome to episode 195 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How you doing, buddy?
I'm good. It's late on a Friday, Andy, isn't it? People who listen to the podcast don't know, but we usually try and do it around a Thursday, don't we? That's why I sound probably slightly hoarse and tired, because, well, I am. So, yeah, I'm good, Andy. It's a long week. And, but it's been a good and exciting week. Plenty going on for me. If you've been following me, follow me on Instagram and Twitter. Our social media, like I mentioned last week, has really gone up a notch. And you'll see some stuff that I got up to during the week. And one of the things I got up to this week was, I talked a lot about flexible working and the benefits. It's for employees and employers, but for me, I managed to fill one of my, knock one thing off my bucket list, which was to watch Messi destroy Tottenham Hotspur this week, which was which was fantastic, and it was great to watch, because it's not often that you get to see a true legend do something that they're amazing at. So that was the highlight of my week. I mean, of course, I have to say also my daughter's Autumn Harvest Festival was a highlight of my week, but obviously Messi was up there too. How are you, Andy? How was your week? I'm
good. And actually, you say it's not often you get a chance to see a true legend at work, but I get to do that every week when I do this podcast with you. Suck up, suck up, suck up. But no, I'm good. Just busy as always. It's the kind of that time of year. Haven't really been up to much. Got nothing to update you with, apart from the fact that my youngest daughter has started football now, and she's absolutely loving it. I know you mentioned a few podcasts ago that you were going up to where England trained to support one of your daughters in her quest to become one of England's finest in the future. So that's quite good to do that kind of stuff with their children. It's always good fun. Although it's getting colder, I'm not looking forward to getting up in the cold mornings and standing on the sidelines.
Yeah, football training in the winter, Andy. There you go. You'll be tested. Your dedication and patience will be tested when you're stood on the sideline.
What have we got on the pod this week? Enough football chat. We've chatted about Tottenham. We've chatted about our daughters. So what have we got on the pod this week? Let's talk money.
We've got the usual three pieces this week, and two of them have actually been inspired by a listener, the same listener. We got a fantastic email, which we'll touch upon in a second. One of the pieces is to do with how you set up your finances at home between you and your partner. The second part is to do with investing and a kind of a macro theme, which I'll explain why. And the last one is about regulation, and about the regulation of financial firms and some of the assumptions based around regulation that consumers have that can get them into trouble. And there were two particular stories that I want to chat through, because they highlight some of the things that people won't realise about regulation, and actually, to be honest with you, Andy, some of the failings of the FCA.
Right, okay, should we start with the email then? Because I've actually got the email too. You kindly forwarded it on to me.
Yes, I do actually forward on your emails to Andy, mainly if you mention Andy in them and say about what a wonderful job he's doing. So if you want Andy to see an email, just give him some give him some praise.
And it's because I'm a really needy person. I say, Damien, please, I need praise. Send me praise. Okay, cool. I'll tell you what, I'll give the start of the email because it kind of mentions, and we always like reviews. It's basically like a mini review via email. And I think you're going to paraphrase and talk about the next part of the email. So John it is who's been in touch, and he says, first of all, you do a fantastic job with your Money to the Masses podcast. Every week it's really, really good. Well done. You should both be very proud. And we are, John. Thank you for getting in touch. Before you say, can you leave us a review on iTunes, let me just say I have twice. And if I try a third time, I'll probably be banned. So that's very kind of you, John. John then goes on to talk about a particular situation that's occurred that he was not really aware of, and it's a lengthy email. You're going to sort of summarise it and cover it on the podcast, I'm assuming.
Yeah, and it was quite a long email, but it was quite an interesting point. Now, I love the intro to that podcast, that dedication to trying to leave reviews. Do leave reviews. Be like John. Leave lots of reviews on the for the podcast on iTunes. Now, to paraphrase John's email, what had actually happened is when he moved into a house with his partner, they set up various bills, like we all do, so council tax, utility bills, water bills, etc. And just like most people do, one person may take the lead on that. And he'd set up all these bills in his name only. Now, it wasn't a particularly deliberate, conscious decision to not have his wife on them, but it just became easier to go down that road. And what happened then, when they decided they wanted to remortgage, they have obviously had to go through various checks, affordability checks with the lender, credit checks, etc. The problem was, when the lender asked to see proof of address, proof of their identity, that John could provide it for himself, but he couldn't provide it for his wife. And they were scrabbling around trying to find utility bills, because the rules generally are you have to have a utility bill that's dated within the last 3 months with your name on. It can be a council tax bill that's within the last year, and it usually can't be a mobile phone bill. So what can happen is that if you don't think about it and plan ahead, you can merrily go around setting up your bills. It particularly happens if you start switching energy bills. So you could have had a bill in joint names. You can end up with one in single name, where one person in the household nearly has all the bills in their name and the other person doesn't. So when you come to money laundering checks, which will always occur if you try to open any form of credit, then you may fall foul. So John was kind of asking, well, what do I do? What's the way around it? The only way around it really is to put the name of the second person on the bills, have the bills in joint name. Now, this is the sort of thing everybody does. It's so easy to do. I've done it. When we moved into this house, my wife and I, you start doing the bills and you just get into a sort of a run, especially when you get married as well, and you have to they change their name. It's one of those things that can slowly sort of slip by. You find that not many bills are in their name anymore, so you have to be quite conscious of it. And I've actually myself done this and had to go back and make sure my wife was on the bills, because one of the issues is that, of course, if she's not on the bill, then if there's a problem, she can't ring up and actually talk to anybody about it, because they won't divulge any information, even if you are married, because the account wouldn't be in joint names. So the short answer is, of course, you're going to have to change your bills the best way. Make sure you're always on the electoral register. That's another money laundering check. Make sure that you've got an up-to-date driving licence with your address on as well, because they can often be used for either a photo evidence, so as of your name, or your address. So normally either one of those is okay as well. Yeah, so unfortunately the moral of the story was that try not to do that, and if you do find yourself doing that and you're going to apply for a mortgage, make sure ahead of time you start to plan. But then John goes on to ask the further question, but hold on, if I start putting bills in joint names, then am I leaving myself open to the idea that if I was ever to get divorced, then I could be stitched? If John's wife is listening, I have massively paraphrased that question, by the way, so he didn't quite say that. I feel bad if they listen to it together and somehow...
I did have a momentary sort of worry and wobble, thinking, I'm not sure.
I'm just worried in case John was listening to this with his wife and he suddenly goes, "This is my question," and then I've just badly paraphrased it at the end, and they're now having an argument. Yeah, unfortunately, there is that issue that if you have a bill in joint name or a bank account in joint names, then you are giving over a sort of an element of responsibility and accountability, particularly obviously in bank accounts is a concern. There are people who will, quite understandably, put money in their spouse's name, and they might do that because it'll be better for them from the purposes of tax. And when the interest is paid, they're not maybe taxed as much if the money's in their spouse's name rather than their own name. And of course, what that does do is actually give the money over to your spouse and the ability for them, especially if it's in their own name, their sole name, just to take that money and do as they please. So, of course, it's one of those things. It's not a perfect world. I mean, part of the idea is that when you get married, it's meant to be forever, isn't it, Andy? So the idea is there's no sort of easy way out of this. So yes, if you do start getting joint accounts and joint bank accounts, then there is an acceptance that you are going to be liable for those. More importantly, it also means even if you're not married, if you start getting joint product names, so joint accounts, joint credit, anything like that, then you're becoming financially connected. And if you're financially connected, then it can start to impact your credit rating. So I know somebody, for example, who has deliberately set up their finances whereby everything is pretty much held in their other half's name because they have a fantastic credit history, whereas a good friend of mine has a terrible credit history, and they didn't want the two to be mixed. It does leave him in a very precarious position, so if for some reason they were to split up, he'd pretty much be left with almost nothing. But for their credit rating, he decided to make that choice. So it's a very interesting question from John. There is no sort of perfect solution, really. You have to just go with what you think is best. But generally speaking, try and get at least some of the bills in joint names. And at least one or two, because that's what lenders will be after. Leading on from that comes into our second piece of the podcast this week, which was John's doing again. And he said he particularly enjoys the macroeconomic pieces that we've done in the past. So they're talking about the generics, the big picture of investing. And so I thought I would go off on one about something that's quite relevant at the moment. And now, I don't know if you've been aware, Andy, you may not have, because it's happened very late in the week, but we've had a bit of an equity market wobble, particularly in the States, and it bled over into the UK and Europe. But
I missed it, Damien.
You missed it, but what actually caused it is quite interesting, and it's again one of these sort of macro things I just want to quickly run through. And it was actually the bond market. Now, the bond market suddenly had a big wobble this week, and if we take a step back and we look at the US in America, now we know that central banks are trying to take the global economy off of the drugs they've been pumping it to try and keep it going. And that means they've been trying to raise interest rates, and they've been trying to think about cutting back on their sort of money printing that they've done and unwinding that. Now in America, they're much further down the road of doing that. They've been raising interest rates a couple of times, and much further than, say, the UK and even particularly Europe. But what's happened, it's been quite an interesting dynamic that while the stock market has been doing quite well, in the last month or so, people who've been 80/20 investor members would have sort of picked up on me starting to highlight a trend in the background that the 10-year US Treasury yield has started to creep up. Now, the 10-year US Treasury yield is basically like a bond that is issued by the government that's got a 10-year term. And that yield is important. That amount of, think of it like the interest almost that you get back for holding that investment. Now, it's obviously a very secure investment because it's going to be repaid by the government. It's basically a loan, that's its format. But all you've got to really understand is that yield starts to dictate a lot of things that go on in the US economy. So the longer there are 30-year treasuries as well. These start to dictate the mortgage rates in the economy, the amount that companies can borrow money at. And as that interest rate starts to rise, it starts to put a squeeze on the economy, if you get my drift, Andy, because it will start to mean if the amount that you can earn on the most secure base investment out there, if that rate starts to creep up, it then means that all the sort of relative interest rates in the economy start to creep up too. And given the way that mortgages are created are based around these interest rates, the rate you'd be paying for a mortgage over the long term will start to creep up. So it starts to squeeze consumers and companies who want to borrow money, and starts to squeeze the economy and dampen the economic growth. Now, in the background, the Treasury yield, go and look it up if you can. Open up your iPhone stocks app, you might see it in there, but it was below 3% recently, and 3% was meant to be this sort of marker that people have said would start to cause a bit of concern that it might start to stifle the US economy and therefore possibly the global economy, because the US economy is powering ahead and the rest of us are kind of just sort of watching as it sort of zooms off into the distance slightly. Now, that yield has started to creep up. It got above 3% and people didn't really pay much attention, but this week the yield jumped up to 3.2%. It doesn't sound like a big jump, but trust me, relatively that is a big jump, and it's the highest level for 7 years. And what it meant is that the way bonds are priced is that when the yield goes up, the price of the bond falls. So don't worry about the mechanics of that, but what you really need to understand is that the bond prices started to tumble, and that was because the yield was going up. And because of that, it got to a point where people started to panic and started to sell bonds, because it was seen as a sign that investors were worried about inflation and the US economy really starting to boom big time. Because think about it, bonds only pay a fixed interest. It's a bit like, it's not cash, it's the next step up. But you think about cash and the interest you get on it. If inflation starts to kick in, which does when economies boom, because obviously everyone has more money and they start buying more goods, and therefore there's less goods or a fixed number of goods with more money chasing, then that pushes the price of things up. If inflation goes up, then that means that the value of your bank account, really, it can buy less, so it starts to diminish. Does that make sense?
Yeah.
And it also is a similar thing with bonds. So what it means is that bonds become less attractive, so people sell them. Well, that should be good news for equities, for shares, because bonds and shares tend to move in opposite directions, not in lockstep, it's sort of complete opposites, but when bonds tend to fall because they're a safer kind of investment, they're lower risk. When they tend to go out of favour, it tends to mean people go into equities and vice versa. But what happened this week? The yield jumped so much that people were worried that it would mean that the impact on the US economy would suddenly shoot up. The rise in interest rates would push up mortgage rates. It would cause the US Federal Reserve to suddenly panic that the rate of inflation was really going to pick up and increase interest rates quicker. And if that happened, then it could start to stifle the US economy, and it could start to mean consumers have less money, and that would then feed through to companies, because then they would start buying less in the shops, and therefore companies would make less profit and share prices would fall. So there's this interesting dynamic. There's a point where investors try and make a decision that the yield is risen to a level that becomes unsustainable. And so what you can get, as we had this week, that bonds and equities started to sell off at the same time, which is really, really unusual. And the last time we saw that was back in February. And that was when the market became really spooked, when yields started to creep up and they just hit the panic button. It was almost a case of, oh my God, bonds are really selling off. Why is that? I think the economy's going to boom too much. That's why people don't want them. Oh my God, if the economy booms too much and inflation is going to spike, that's really why, that's really serious. And I think we don't want to be in equity, so they panicked. And then eventually that panic, it was actually exaggerated slightly by those bizarre structured products it was exaggerated at the time by certain products out there that were betting against market calmness, or they were betting, that the market would remain calm, and it didn't. We haven't had that this time. But the point is, we kind of got back to the world of March 2018. So we're looking at this now thinking, well, are we about to have a really severe correction? Are we going to have another 10% fall in equity markets? So we don't really know that right now. And I talk about it in this week's newsletter for 80/20 investors. But what we could be having is we could just be having a bit of a sort of a re-rating, a shock, where people have suddenly decided, you know what, the US economy is doing better than we thought. And what's actually, jumping back slightly, what sparked this sudden panic this week was some really strong economic numbers that came out of America that showed that jobs were being created at a faster rate and the economy was doing really well. So suddenly people were like, blimey, it's doing much better than we thought. And the US Federal Reserve might have to cool things down by raising interest rates. Then that was obviously why it all fed into that dynamic of bonds, which ended up causing equities to sell off. So it's a really interesting dynamic. Now, if you add into that the world isn't isolated, it isn't just the case that we all just follow what goes on in America. At the same time, over in Europe, in Italy, the populist government that's there has decided to release what their budget proposals are, how much money they're going to spend. And they're going on a spending spree. And if anybody goes on a spending spree, then somebody's got to pay for it. And that means that normally governments pay for things in various ways, taxes, and one of them is issuing things like bonds. So it means that the credit almost worthiness of somebody who's going on a big spending spree, let's put it this way, Andy, Would I lend you money if you suddenly turned around to me and said, "Look, Damien, I'm going to go on an absolute bender for the next 2 weeks and spend loads of money drinking and whatever." I know you don't drink. Let's pretend you do, but you're less likely to want to.
Yeah, probably not. But I'm just thinking about the days when we met, and that regularly used to be an occurrence.
That's how we became friends. For anybody who listens to this podcast, those were the days. But you're less likely to. So what happened? Bond markets started to get a bit worried in Europe. They were thinking, hold on a second, if Italy are going to go on this mass spending spree, that kind of puts them at odds with the rest of Europe and any form of trying to be maintain some sort of sensible budgets. Bond investors are thinking, well, if they're going to go on a spending spree, then they're probably going to end up being even less creditworthy. Do I really want to hold the bonds of a government that could potentially go bust? Don't forget that Italy has the second highest debt to output of any country in Europe, second only to Greece, and we know what happened in Greece. And the other interesting thing that occurred is that, or the dynamic is that in Italy, the banks hold a lot of their government's debt, so a lot of their government's equivalent of their bonds. And they've loaded up on this stuff over the years, where the rest of Europe has been selling it because they're thinking, I'm not too sure I want to be on the hook for basically lending money to the Italian government. Italian banks have been doing the opposite. So with this idea that the Italian bonds were looking a little bit less exciting and a little bit sort of nervous, something you wouldn't necessarily want to hold, they started to sell off, so their yields started to jump. And it meant it got to the point where, so if you think about that logically, if Italian banks hold a lot of this debt, it's basically like in their investments, but they hold a lot of this effective Italian bonds from the Italian government. They're holding lots of that stuff to shore up their balance sheets, and that stuff starts to become worth less than it was, say, a week ago or 2 weeks ago, and it starts to tumble in value. That then starts to make the balance sheets of the Italian banks look a bit shaky. Then if they start looking a bit shaky, then the banking system is all interconnected throughout the world, and particularly in Europe. Then we start looking at the idea of a banking crisis. So you can see that the bond markets are having all these things they're worrying about, that even if you don't invest in them and you're an equity investor, you might be looking at your portfolio this weekend and not been paying any attention to what's going on, and suddenly thinking, oh my God, how come it's fallen by 3% in days, and I'm invested in bonds and equities? I thought this was meant to be diversified. Now, the piece I've just explained is why. Bonds have had a bit of an earthquake, so there's foundations, you imagine, like I've said before, building, very tall building. The low risk stuff's at the bottom. There's been a bit of a wobble. The stuff at the top, which is equities, has wobbled a bit more. Now, we don't know what's going to happen. It may carry on. It may slow down. It may actually just be a period of we sort of re-rating the world and actually admitting finally that, yeah, the good times have come to an end in terms of monetary policy, and interest rates are going to start rising. It doesn't have to mean that the markets collapse. It may be they just consolidate. Because interestingly, in America, when the Fed raised interest rates the other week, you'd think the market would have basically done what it's done in the last couple of days. Yields jumped on bonds and equity markets have a bit of a wobble, but they didn't. They sort of just took it in their stride. It's almost like there was a bit of a delayed aftershock. So, yeah, it's quite interesting. And just to chuck a bit of a sort of term that I came across that made me laugh, that thing I described about Italian bonds and their banks, that's called the doom loop. So the doom loop, if you ever hear the doom loop, it describes that idea of banks that hold their government's bonds, and if the government is then looking not very creditworthy and people are worried about its spending, and then the banks then start, their investments go a little bit wobbly because they're holding their own government's bonds, that doom loop can then cause extra ripples. So there you go, Andy, a bit of a macro thing there. I covered quite a lot, and before I finish, I'll just throw it out there. If somebody wants me to explain it further, I can do, but another thing that's been interesting it's probably been in the last 6 weeks that again hasn't grabbed the headlines because it's been slow and steady, is the decline in tech stocks. And they've led a lot of the way in this bull market. And the bull market has narrowed, and that's always a sign of a kind of a later stage in a bull market. Rather than lots of different sectors all doing well or different geographies doing well, we've kind of got to the point where if you wanted to outperform anybody, it wasn't to be diversified. It was basically to hold US equities and principally tech stocks. Now, in the last couple of weeks, US tech stocks have started to sort of tail off. Not collapse, but they've tailed off. And that can be a sign of profit taking, but it could also be a sign of this idea that people are getting used to interest rates are going to have to start rising around the world, and particularly in America, because tech stocks, don't forget, you think of the big tech giants, some of them don't earn any money now, and they earn it way off in the future. There's a future payday, and if you discount back that future payday, that's kind of how you get to the share price now. So that's why tech stocks look less exciting in a world where that discount rate is higher, i.e. when interest rates rise. Conversely, financials, so we're talking about banks, they did quite well this week, and that is perhaps to be expected, because in a world where interest rates rise, then banks tend to do better. Just think about what happened in the Bank of England scenario back in the UK. When the Bank of England raised interest rates recently, what happened? They didn't pass it on, did they? They basically bumped up their mortgage rates and kept their savings rates low. Basically, banks used the rate rises to shore up their balance sheets and to make greater profits. And that's why holding bank shares in a rising rate environment tends to be better. We've seen that kind of dynamic that going on, particularly in America. So it could just suggest that this wobble we've got is just people shuffling the decks, expecting now, do you know what? This new era is coming in with rates might go up. It could be something much bigger, but we don't know. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers in the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so like most people, Damien, we obviously like to leave the best for last, and of course the best for last is regulation, that wonderfully exciting subject of regulation. And the FCA, what have we got?
Don't switch off. Don't touch that button. This is interesting, and it's important actually. Now, obviously the FCA is important. They are the body that basically watches over the financial services sector, and they make sure that consumers don't get ripped off. But they're not perfect, and the next two stories, which I'm going to quickly run through because I'm conscious of the time, highlight some of the sort of issues with the way regulation works and FCA works in this country. Some people give them a really hard time. They can be slightly very slow to react to things. Sometimes it can be a bit overzealous, but you've got to realise they're there for the protection of consumers, so they are important. Now, what's happened? The first story I want to talk about, there was a chap, okay? He decided to go, I think he was approached by a firm regarding investment. Now, what he did, he's been very sensible. It's a financial advisory firm. He looked at the firm, thought, I'm going to go and check the FCA register to see if they're authorised. He went on the register, saw that they were authorised, and then ultimately he decided to do business with this firm, and he parted company with £40,000. Now, this firm wasn't what he thought it was, and basically they were con men and they disappeared into the sunset with his money. What was interesting about the story, though, is that the gentleman complained to the FCA because what the con men had done is they had found a loophole. Let's say it's not perhaps not even a loophole, but basically an oversight, laziness, whatever you want to call it, by the FCA, where the FCA register, because there is a register of all regulated firms that the FCA is supposed to upkeep for consumers to look at. This firm that was on there had actually ceased trading about 4 years previously, but conmen had actually, and fraudsters had worked this out, that the register wasn't up to date, and therefore used the name of that particular firm and approached the guy. So when he then went and looked on the register, he quite understandably thought they were legitimate, and then he decided to do business with them, and that's where they disappeared off into the sunset. So what do you think happened? He complained to the FCA, and you might think that they might sit there with all their money and hold their hands up. What they actually did was take quite a long time to reply, and then offered him, I think, about £150 in to say sorry for the delay in responding, and said it's not our fault. Now I think that's outrageous. I can't believe our regulator can sit there and just dismissively just say it's not our fault. I agree. It was the FCA did not steal the man's money, but as the gold standard of what they expect of the industry, I don't accept the fact that the FCA shouldn't have been held to account. Now, the guy actually complained to the Complaints Commissioner, and what happened, they actually found that in favour of the gentleman, and said that the lapse sort of actions and upkeep of the register of by the FCA actually contributed to the man losing his money, and therefore said that they should offer him compensation. They didn't stipulate the level, and the FCA eventually gave him £20,000, basically half of what he lost. So the man is still out of pocket, and in fact he wants to sue the FCA because he feels they're not fit or proper, and not actually fit for the purpose, was his exact phrase that he was quoted in the newspaper as saying, but he can't afford the fees. Now, that story in itself is a lesson, because while the first thing you'd say to people is obviously go and check the FCA register, you'd hope it was be up to date. We can't even trust the FCA is the ultimate answer to that. So what can we do? The only thing I can suggest is if you check Companies House, because presumably if perhaps he checked Companies House, I don't know in this instance, but I'm guessing that he would have found that the company wasn't actually in business. If that's the case, then he may have been alerted. Of course, you need to have it's best to get a referral from somebody you know independently, or perhaps you get a referral for something like Vouched For, which is vouchedfor.co.uk, which actually has reviews of these companies, IFAs all throughout the country, mortgage advisors all throughout the country. So it was an unfortunate story, but it's one of those where even if you think you're doing the right thing, then you can still fall foul of the comment. And it just proves also that anybody can be conned. Now, the next one I want to quickly run on to is slightly different, but again, it's this grey area of regulation and what people understand by regulation. Now, there's a company called Premier FX that went bust in July that hit the newspapers. And cut a long story short, a lot of people lost quite a lot of money. And what the company did, it actually enabled you to transact in foreign currency. So let's say you were going to buy a house abroad, it would actually enable you to make the transaction and transfer the money overseas. Now, this company was regulated. It was regulated to do that one activity, which was obviously the transmission of the currency abroad. It wasn't regulated for holding money like a bank. Now, what happened, there was no suggestion really from that the company was in any way doing anything fraudulent, but the owner of the company actually died unexpectedly, and so the company therefore passed on to his children, and they were obviously adult children. They decided to wind the company up and basically pull down the shutters, which left the customers wondering what was going to happen. What had been going on in the background is that the company had been holding people's money on account. So it was actually almost acting like a bank when it shouldn't have been. Now, there's no suggestion that the person was trying to be fraudulent who was running the company, but they were actually doing something they shouldn't have been doing. The money wasn't meant to be held in any account. So that meant when the company became wound up, that when they were paying off creditors and everything, there were people who had money just locked away and that got swept up in the unwinding of this company. And there was one gentleman who had £100,000 of his life savings that was meant to be going to buy his dream house over, I think it was in somewhere like Spain, got locked away and is lost, and he's wondering whether he will even get any of his money back. Now, obviously when this whole thing becomes resolved, when they've obviously wound up the company, he may get something back. But what is interesting about this story is that people immediately thought, oh, well, I'll be covered perhaps by the Financial Services Compensation Scheme. Now, that's the scheme that if you hold money in a bank, if the bank goes bust, assuming the bank is regulated and is covered by the Financial Services Compensation Scheme, if the bank goes bust, you're covered for £85,000 per account per banking licence, and that's doubled to £170,000 for a joint bank account. Now, the problem is that not everything that is regulated is covered under the Financial Services Compensation Scheme. Things like investments are, banking is, financial advice is, but what this company was regulated to do by the FCA was just to transmit this money. It wasn't regulated to hold money like a bank. So it was performing a non-regulated activity, which is where the people lost their money. As such, they were not covered under any form of regulation. The company was doing something outside of its regulation, but in any event, even if they'd lost money via the transmission, which it was regulated for, they still would have been covered by the Financial Services Compensation Scheme. So the moral of this particular story is you have to ensure that you check what level of cover that you would have under any schemes like Financial Services Compensation Scheme, what the companies are regulated to do, what it means, and what they're not regulated to do. Now you may think, well, why didn't the FCA know this? But the problem is the FCA doesn't work in a way that it checks people. It works in a way that it may do checks every now and then on a company, but it doesn't look at the things it's doing outside of the regulation. It was regulated to do one thing. The FCA is not concerned about the other things that it may be doing unless it ends up doing something it's brought to its attention that it shouldn't be doing. But of course in this instance it wasn't. So it's regulation, Andy. It's one of those confusing areas that I think people in the industry get frustrated with, and I think consumers get incredibly confused about. But it's important.
Okay, good stuff. We're done, and of course, it would be great if you, the listener, could get online and give us a review. Haven't had one for a little while. There's a few techie things in the background that we've fixed up. That was perhaps part of the issue, but if you could get online, give us a review, send us up those charts, that would really help us. And Damien, you're not actually here next week. I'll still give out the details so that people can get in touch, because there'll be one in a couple of weeks later. You'll explain why you're not here in a second. So if you need to contact Damien or want to contact Damien, it's at Money to the Masses with the number 2. That's the Twitter address, and it's Damien at moneytothemasses.com. Damien, you're off next week. What's going on?
I'm going to Venice. I've never been there.
Nice.
Yeah, I'm going with my lovely wife to celebrate our 10th wedding anniversary, which was a little while ago. So sort of an impromptu trip to Venice. So if anybody out there has any recommendations about where to go, what to look at in Venice, then feel free to tweet me.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.